Hello guys, welcome to our YouTube channel TechBird. Today we will cover another domain knowledge and its financial term. It's invoice versus bill versus receipt. A detailed comparison we will do between these three terms. So let's say receipt. I will pay the hotel bill when we check out. You can pay the invoice using either your credit card or cash. Thank you for purchasing. Please collect your receipt. Now, you might have come across the terms invoice, bill, receipt in your daily life. Although these terms are often used interchangeably, bearing some similarities, they are fundamentally different from each other. So, let's see what is the difference in invoices versus bill. So, what is bill? A bill is a document issued by vendor that specifies the amount the buyer owes for the goods or services purchased from them. In B2C setting means business to customer. Say a retail store or a restaurant, the buyer is expected to pay immediately after receiving the bill. Whereas during B2B transaction mean business to business, bills payable show the amount customers owe for the goods and services sold on credit and is expected to be paid by a certain date, not immediately. It can include service invoices, phone bills, utility bills, like invoices. Bills serve as a legal evidence of the transaction. So, how are bills different from invoices? A bill and an invoice refer to the same document, which conveys the amount owed as part of the business transaction. The difference is how it is perceived, depending on whether you are a seller or a buyer. So, based on perspective, when a seller sends an invoice requesting payment, the buyer will receive it as bill. For instance, on delivering their work as part of the agreement, a freelancer designer would send an invoice to their customer. For the customer, the document receipt would function as bill. To sum it up, sending an invoice is to request payment and receiving a bill is to pay for the purchase. So based on the payment terms, apart from this, the timeline by which the client is expected to pay plays a differentiating factor. Few businesses and vendors, especially in the B2B setting, offers products or services on credit, which means the client can purchase and pay the vendor later as per the agreement upon payment terms. In such cases, after delivering the goods or services, the supplier sends an invoice. If the invoice includes payment terms such as net 30, which indicates that the client is supposed to make payment within 30 days upon receiving the invoice. The customer is expected to pay within time frame stated. So when it comes to invoices, there is an option to pay later. However, the bill is issued immediately following the product or service delivery, and the seller expects their client to make payment then and there. A typical example can be a bill issued after you stay at a hotel, which is to be paid before you check out. So the main difference is that while an invoice is sent by the seller, the bill is received by customer. Now see invoice versus receipt. So what is receipt? A receipt is an acknowledgement or a proof of payment. It contains the seller's details and the buyer's, including the items bought, the date of payment, the amount paid, and other relevant information. Key difference between invoice and receipt. So invoices and receipts are similar. They serve as a record of sales and commonly mostly the same information. The difference lies in when they are issued and how they are used for accounting purposes. While an invoice is raised to get payment from the customer, a receipt is issued after receiving the payment from the customer. Now see, typically a receipt is issued only after customer pays in full, other than the obligation to fulfill refunds or replacement claims. The sale is considered closed. A receipt serves as a record of a completed sale. which goes into the books as income. On the other hand, the seller can issue invoices to the customer who have credit accounts, enabling them to get goods or services beforehand and pay later. Sellers can even split the total amount into several invoices and get paid in installments. Invoices are recorded differently in the accounting system. Rather than registering the sale as income, the invoices are marked for further processing and treated as account receivable. Account receivable. Only when the full payment is received for the goods or services provided will the sale be considered complete and recorded as income in the books. Invoices versus bill versus receipt. So this is the, you see here, this is the brief categorization developed from. So what is it? So first see invoice. So an invoice is a document sent by the seller to their customer to notify them of the total amount they owe for the goods and services delivered. Bill. A bill is formal document a customer receives from the vendor that states the amount they have to pay for goods or services purchased. Third is receipt. A receipt is issued by the seller to acknowledge the payment received from the customer. So how is it used? So first in invoices. Invoices can be personalized and are widely used by businesses to sell products or services on credit. A seller can issue an invoices both for a single sale or recurring sale. Bills are mostly generic and issued with an intention of getting paid immediately and do not provide any extension on the credit limit. A seller is issues the bill for a one-time immediate payment, predominantly for retail services. Receipts serve as a proof of payment for the products and services purchased. Customer can use the receipt to claim refunds or replacement for faulty goods or services. So when is it used? An invoice is issued once the product or services are delivered. It includes the payment terms specifying the payment due date, the total amount due, the period within which the customer has to make the payment. On the other hand, businesses offering subscription services raises invoices at the end of every billing cycle, and customer pay recurring to renew the services. Lawyers, accountants, business consultants, and freelancers issue their client invoices periodically as agreed in the contract to get paid. A bill is also issued immediately after the purchase is made or the services are rendered. A typical example can be the bills generated in hotels, grocery stores, and other retail shops where the customer has to make the payment then and there. Receipt is issued after the payment is received. For example, in a restaurant, after the customer finishes eating, they receive the bill to make payment. Once the customer pays, the restaurant provides a receipt to acknowledge the payment. How does it help? Invoices are useful for accounting, tax billing purposes, keep track of sales and inventory. Bills serve as a proof of purchase between seller and buyer. Receipt helps sellers file taxes and claim tax deduction on business expenses. Since receipts are used as proof of payment, buyers will need to keep them handy if they want to initiate returns or replacement with the vendor. What does it include? So the word invoice, so what does it include? Invoice include word invoice, invoice number, seller and buyer details, invoice issue date, delivery date of products and services, description of goods or services delivered including cost per unit and total item cost, total amount charge including tax information if any, payment terms and options, terms and conditions related to late fees, return replacement goods, etc. Now see What does bill include? So bill includes sale date, seller and buyer detail, description of the goods services purchased, total amount to be paid including the tax or fees details, payment method, and warranty details. Now receipt have payment details, referral invoice number, receipt number, supplier detail, customer details, total amount paid, payment method, terms of sales, organization's written policy. So this was the difference between invoices, bill and receipt. I hope you will be benefited by this. You will be benefited by this video. For more video, please subscribe our YouTube channel. The name is TechBird. So I'll meet you soon. Till then, goodbye.